International assets are a crucial part of any well-diversified investment portfolio. Here we'll look at the best international ETFs for both stocks and bonds across developed and emerging markets. So why would we be interested in international stocks and bonds in the first place? International stocks inarguably offer a diversification benefit by not being perfectly correlated to the US market. That is, international stocks do not move in perfect lockstep with US stocks. At their global market weight, US stocks only comprise about 50% of the global stock market. Top target date funds now allocate over 30% of equities positions to ex-US stocks. Moreover, considering the historical performance of emerging markets, excluding international stocks may mean missing out on great investment opportunities. Also consider that international markets contain most of the largest automotive, telecommunication, and electronics companies. No single country consistently outperforms all the others in the world. If one did, that outperformance would also lead to a relative overvaluation and a subsequent reversal. Meb Faber found that if you look at the past 70 years, the US stock market has outperformed foreign stocks by 1% per year, but all of that outperformance has come after 2009. During the period 1970 to 2008, an equity portfolio of 80% US stocks and 20% international stocks had higher general and risk-adjusted returns than a 100% US stocks portfolio. Specifically, international stocks outperformed the US in the years 1986 through 1988, 1993, 1999, 2002 to 2007, 2012, 2017, and 2022. The important takeaway is that it's impossible to know when the performance pendulum will swing and for how long, much less how those time periods would match up with your personal time horizon and retirement date. Moreover, US stocks outperformance on average over the past half century or so has simply been due to increasing price multiples, not an improvement in business fundamentals. That is, US companies did not generate more profit than international companies. Their stocks just got more expensive. And remember what we know about expensiveness. Cheap stocks have greater expected returns, and expensive stocks have lower expected returns. In short, geographic diversification in equities has huge potential upside and little downside for investors. Now we'll go over the 9 best international ETFs segmented by asset type. First, we'll cover the best international stocks ETFs. Vanguard International ETFs offer some of the cheapest exposure to assets outside the US. The Vanguard Total International Stock ETF, VXUS, is the most popular broad international stock ETF, and for good reason. The fund has a very low expense ratio for the space at only 0.07%, providing affordable access to the total international stock market. This ETF seeks to track the FTSE Global All Cap ex-US Index and has over $420 billion in assets. Similar to VXUS is the Vanguard FTSE All World ex-US ETF, VEU. The fund seeks to track the FTSE All World ex-US Index and also has an expense ratio of 0.07%. Both VEU and VXUS are highly liquid, broad international stock ETFs. Their performance has been nearly identical historically. VXUS is arguably more diversified with roughly 7,500 holdings compared to 3,500 for VEU. I delved into the specific comparison of VXUS and VEU in more detail in a separate video here. Basically, one should objectively prefer VXUS over VEU, but they make a great pair for tax loss harvesting purposes. The iShare Core MSCI Total International Stock ETF, IXUS, is another broadly diversified international stocks ETF. The fund seeks to track the MSCI ACWI ex-USA IMI index and has over $20 billion in assets and 4,300 holdings. This ETF has the same expense ratio as the others at 0.07%. This one would also be a fine replacement for VEU or VXUS to avoid a wash sale across multiple accounts if you plan to harvest losses. Investors seeking to only invest in developed markets outside the US will enjoy the Vanguard FTSE Developed Markets ETF, VEA. This fund seeks to track the FTSE Developed All Cap ex-US Index. It has over $120 billion in assets, over 4,000 holdings, and an expense ratio of only 0.05%. For a US investor, if you hold VEA, you'll also probably want some VWO, the Vanguard FTSE Emerging Markets ETF. VWO provides exposure to emerging markets via the FTSE Emerging Markets All Cap China A Inclusion Index. As you can see from the index name, VWO includes China and other developing countries like Taiwan, India, Brazil, etc. VWO has a fee of 0.0 0.08%. VWO may be the most important fund on this list. Developed markets, like with the fund VEA, are highly correlated with the US market and thus don't offer as much of a diversification benefit. Emerging markets are a superior diversifier and have also conveniently paid a significant risk premium historically. I purposely overweight emerging markets in my own portfolio for these reasons. Emerging markets comprise about 11% of the global stock market. Note that emerging markets as a whole are more volatile than developed markets. VXUS for the total international stock market is roughly a 3-to-1 ratio of developed markets to emerging markets. Specifically, VXUS is about 75% VEA and about 25% VWO. Now we'll check out a few of the best international bond ETFs. First is BNDX, the Vanguard Total International Bond ETF. BNDX provides broad USD hedged diversification across the entire foreign bond market. The fund has over $150 billion in assets, an average maturity of about 10 years, and an expense ratio of 0.07%. This ETF seeks to track the Bloomberg Barclays Global Aggregate XUSD float adjusted RIC capped index, which is USD hedged. While I usually prefer to stick to treasury bonds, if I were wanting to buy a broad international bond fund, this would be the fund I'd choose, simply because it's much cheaper than IGOV, which we'll go over in a second. Next up is IAGG, the iShares Core International Aggregate Bond ETF. IAGG is a broad international bond ETF from iShares. The fund seeks to track the Bloomberg Barclays Global Aggregate XUSD 10% issuer capped hedged index. This ETF is roughly equivalent to BNDX, but with a slightly shorter duration. The expense ratio for this ETF is 0.07%. IAGG would be a suitable replacement for BNDX for tax loss harvesting purposes. Those seeking exposure to only foreign treasury bonds may appreciate the iShares International Treasury Bond ETF IGOV or IGOV. This fund seeks to track the FTSE World Government Bond Index and has an expense ratio of 0.35%. Note that this fund only holds foreign bonds from developed countries and does not include emerging markets government bonds. Its average maturity is about 11 years. Last on our list is VWOB, the Vanguard Emerging Markets Government Bond ETF. VWOB provides access to USD denominated government bonds in emerging markets. This exposure may benefit investors who only hold US bonds, as bonds from emerging markets are lowly correlated to US bonds. They also diversify the investor's credit risk, as these bonds are inherently riskier than US Treasury bonds. Historically, investors have been compensated for taking on that extra risk. This diversification comes at a cost, as VWOB has a fee of 0.20%, a bit higher than our other funds on this list. VWOB seeks to track the Bloomberg Barclays USD Emerging Markets Government RIC Capped Index. All these international ETFs should be available at any major broker. Do you own any of them, or are you thinking about buying any? Let me know in the comments. Thanks for watching.